Good afternoon, everyone. I want to thank you for attending our webinar today. I'm sure you've seen numerous webinars and COVID-19 related topics out there, as there's really been new developments on a weekly basis or even a daily basis recently. So most of the webinars and news articles that I've seen have focused more on the small business or individual tax effects of recent legislation, as well as placing kind of a large emphasis on the Paycheck Protection Program and SBA loans. As we began putting together a presentation for our government clients and the staff that work on those engagements, it was evident that the same resources really were not available regarding the local government impact of the federal stimulus legislation. So we put together this webinar. We actually shared this with our external clients yesterday. And then also, additionally, at the beginning of April, we released an alert article that's posted on our website that kind of goes through the highlights of the CARES Act specifically. So before we get into much more of the material, I just wanted to first introduce myself and my co-presenter for today's webinar. I'm Tracy Bedgood. I'm a senior manager in our Hampton Roads audit practice, and I do spend most of my time working on governmental entities out of our Virginia Beach office. I'm also pleased to have with me Greg Miller. If you want to introduce yourself, Greg.
Hey, thanks, Tracy. Good afternoon. My name is Greg Miller. I'm a director in our government services group, kind of serving clients all over the Commonwealth, but based out of the Richmond office.
Okay, great. So we're going to move right into today's webinar agenda. The game plan for today is to first go through a summary of an overview of the federal response to date related to COVID-19, and then discuss some relevant items that are included specifically in the Family First Coronavirus Act, as well as the CARES Act. And then after I go through that information, Greg's going to discuss some impacts on financial reporting and compliance, including some relevant GASBS and uniform guidance considerations. So before we get into it too much further, I want to show the code word number 1, which is going to be impact. So if you want to enter that code word or write it down to enter later and to engage you, that'd be great. So code word number 1 is impact. So let's briefly talk about an overview of the COVID-19 federal responses to date. There have really been 3 main emergency relief packages that have been signed into law to date in response to COVID-19. First was the Coronavirus Preparedness and Response Supplemental Appropriations Act that was signed into law on March 6th. And that bill provides an initial response to the coronavirus by providing $8.3 billion in emergency funding for federal agencies to respond to the outbreak. Of that amount, about 81% of that was for domestic response, and the remaining portion was for international response. The second piece of legislation was the Family First Coronavirus Response Act, and that was enacted on March 18th. That bill responds to the coronavirus outbreak by providing paid sick leave, as well as tax credits, free COVID-19 testing, expanded food assistance and unemployment benefits, as well as increased Medicaid funding. Finally, the third emergency relief package was the Coronavirus Aid, Relief, and Economic Securities Act, which most people hear as being referred to as the CARES Act. That one came into play on March 27th, and you've probably heard the most about this particular act. It's 880 pages, and it encompasses a vast array of funding provisions and assistance that range from small business and individual relief, as well as additional funding through various agencies of the federal government. Just briefly on the first package that was released for the Coronavirus Preparedness and Response Supplemental Appropriations Act. This was an initial response. So there was $6.7 billion that was designated for domestic response. The majority of that was for the Department of Health and Human Services specifically, but the portion that I wanted to highlight here that really relates to local governments would be the $1.9 billion for the Center for Disease Control and Prevention. That actually includes $950 million for state and local response efforts, of which about half of that was to be allocated within 30 days of the bill. So it should have already been allocated. The remaining portion was to be put into a reserve fund to help with the replenishment of the Infectious Disease Rapid Response Reserve Fund. As far as the second piece of legislation that was enacted, as I mentioned earlier, this one responds to the COVID-19 outbreak by providing paid sick leave, tax credits, COVID-19 testing, as well as some expanded unemployment benefits and Medicaid funding. This slide summarizes some of those items that are relevant to local government specifically, and these are the items that we're going to discuss in a little bit more detail on the following slides. The Act includes mandates for emergency paid sick and family leave. The governments are included in this mandate to provide these benefits to their employees. There are also tax credits that are generally available to employers under Section 7001 through 7004 of the Act. However, unfortunately, governments are not currently eligible for those tax credits under the current legislation. Although the tax credits aren't available to the governments, governments do not have to pay Social Security tax on those wages because they're not considered taxable wages for Social Security purposes. So let's go through the pieces of the Family First Coronavirus Act a little bit more specifically. There's four main components, as I mentioned before, and I have them listed on this slide. It is important to note that the leave provisions that are included in this Act are effective from April 1st of 2020 through the end of the year on 12/31. The emergency paid sick leave portion is payable to employees that are unable to work or telework due to these items. You'll notice that some of them are in blue font and some are in red. For the items shown in blue font, the employee will receive 100% of their regular pay, rate of pay, up to a maximum daily and total limit that's set. For the items that are shown in red font, the employee will receive 2/3 of the regular rate of pay, up to a maximum daily and total limit set. So how much exactly are employees being paid under this mandate? The sick leave pay is at 100% of regular pay, and it's limited to the daily maximum of $511 per day and $5,110 over the 10-day or 80-hour time period. The pay under FMLA is at 2/3 of the regular rate of pay, and it's limited to $200 a day and $2,000 for the total of the 10 days or 80 hours. It's also important to note that an employer cannot require an employee to use other leave benefits that may be available to them first. For the emergency FMLA leave, the employees must have been employed for 30 days, unable to work or telework due to caring for a minor child if school's closed or the child care provider is not available due to coronavirus precautions. And the employee must have also used 10 days of leave not funded in this mandate prior to receiving benefits under the FMLA leave. The employee may use their accrued PTO, vacation, or other sick leave for those first 10 days, or the employee could use the mandated paid sick leave if applicable for the first 10 days. And then finally, if an employee takes a coronavirus-related leave, is the employer required to restore an employee's position? Well, the short answer is yes, except for some exceptions that are available to employers with 25 or fewer employees. The employer is required to restore an employee's position. So now that we've gone through the benefits to the employees, I just wanted to talk about what relief is available to the employers. So for all of the employers, emergency leave under sick leave or FMLA are not considered to be wages for Social Security purposes. So that means that the employer will not have to pay the employer's share of Social Security on those items. There's an additional benefit to non-government employers that I mentioned earlier related to tax credit relief on payroll taxes, but unfortunately the legislation does not include that benefit for governmental entities. We've had a webinar on this topic, so if you wanted to get any additional information or if you have clients that have questions, you can certainly check out our resources that are available. So I'll move into the second code word now, which is going to be the CARES, C-A-R-E-S. I'll give you a moment to jot that down or to enter it in to engage you. Again, code word number 2 is CARES. Okay, hopefully everybody got that. I'll move on. So although this next item is part of the CARES Act instead of Family First that I've been talking about, I wanted to briefly talk about it at this point of the presentation since it does deal with payroll and employee benefits. For payroll tax deferral, I just mentioned that payroll tax credits are not available to government entities. The CARES Act does provide for deferral of employer share of Social Security taxes that are due between March 27th and December 31st. These payroll taxes can be deferred for 2 years, with 50% of that deferral due by 12/31/21, and then the remaining 50% is deferred until 12/31/22. This deferral is not available to employers who have debt forgiven under the Payroll Protection Program loans. Excuse me. So governments are not generally eligible for those PPP loans, so it's kind of a moot point for governments. The CARES Act also provides for emergency unemployment tax relief by providing payment to states to reimburse for half of the costs incurred through 12/31/20 to pay unemployment benefits. Many states are providing relief by delaying payment and filing requirements of the state unemployment taxes and protecting employers from having a tax rate increase in the future based on unemployment claims that they're experiencing now. So please just, I know that we have clients in various states, and the staff and seniors that are on the call today may work in various offices. So this is a state-specific determination. So I would just recommend that our clients check with their specific state to see what types of benefits may be available specifically to them. So now let's just get into the bulk of the CARES Act. As I mentioned, the CARES Act encompasses a lot of information. It's broken down into 2 parts. Primarily, we are going to be focusing on items that would be relevant to local governments. So specifically, Title II, Subtitle C, related to delay of payment of employer payroll taxes. Also, we'll be talking about the Economic Stabilization Act, as well as the Coronavirus Relief Fund, and the Division B that encompasses emergency appropriations for various agencies. Just to give you a perspective from a dollar perspective of kind of some of the items that CARES Act includes. I've listed them here. I have the two bold bulleted points for the items that are related to local government that we're going to discuss a little bit further. The Coronavirus Relief Fund consists of $150 billion that's allocated to governments and state territories and tribal areas. It's based on population, and the bulk of the funding would go directly to states using a population-based formula to determine what each state receives, although it would be no less than $1.25 billion per state. The local governments with a population over 500,000 were able to apply for their own direct funding, and those that fall below the population threshold would need to go through their states for funding. There wasn't a remaining portion of $11 billion that was distributed to District of Columbia, territories, as well as tribal governments. You may have heard a lot of discussion on this topic recently in the news. The governments with greater than 500,000 were able to apply for direct funding, and they had to submit an application and certification by April 17th. For governments with less than that population, there really hasn't been specific guidance about if those funds will be distributed to the local government. Since those funds have not been extended for direct access to small and mid-sized communities, there are a lot of efforts underway at the state and federal level to try to interpret and amend the CARES Act legislation to require that funds be distributed to local governments under 500,000. Many organizations are recommending that government entities reach out to governor's office to urge them to create a mechanism for distribution of these funds. There are also efforts underway to pass new legislation that would provide some additional funding for local governments. I heard something just as recent as yesterday that they are, discussing some additional fourth package that may come out, but it doesn't look very good right now. They did release a 3.5 stimulus package in latter April, but unfortunately it didn't include any additional relief for local government. When it comes to the Coronavirus Relief Fund, each state has the flexibility to determine how local government funds may be distributed. So the treatment, distribution, and timing of those are likely going to differ depending on the state. As recently as a few days ago, I saw an article about Virginia specifically, and that indicated that the governor has given state agencies until Monday, May 18th, so this coming up Monday, to submit requests for use of federal aid that's sent to Virginia as part of the CARES Act. According to the article, the state administration does plan to formally notify localities on Tuesday regarding the plans to distribute that money. So just keep your eyes and ears open to that information. I'm sure that other states will be doing similar. So the big question is, what exactly are eligible expenditures? The qualifications for using the funds are that the costs incurred are necessary expenditures due to the public health emergency resulting from the pandemic. The expenditures were not accounted for in the budget that was most recently approved as of the date of enactment, which was March 27th. And the expenses were incurred during the period from March 1st through December 30th. The original legislation also made it clear that funds were not to be used to directly account for revenue shortfalls. Since the original act provided such limited guidance on the types of expenditures eligible, the Treasury Department released additional guidance on its website on April 22nd. The additional guidance sets forth some additional interpretation of the limitations for the permissible use of fund payments that was included in the original legislation. They talk about necessary expenditures being incurred due to the public health emergency. So they did expand upon what requirement, what due to the public health emergency means. They also talk about what makes an item be necessary under the stipulation that it has to be necessary and incurred due to public health emergency. This additional guidance also provides some non-exclusive examples of what eligible expenditures would be, and it also includes some examples of ineligible expenditures. So I found that this is good guidance to forward along and share with our clients so that they have some additional guidance as to what that covers. I know the majority of the questions we've gotten so far have pertained to this topic. I just wanted to note a couple of items that are cited in the additional guidance on the website that was released on April 22nd as they relate to some of the questions that I've just received today, actually. So one of the items that they're listing as being an eligible expense is payroll expenses for public safety, public health, healthcare, human services, and similar employees whose services are substantially dedicated to mitigating or responding to the public health emergency. So it's a pretty cut and dry answer related to public safety and public health, those types of areas. But you might be getting into a little bit more of a gray area when it comes to payroll expenses that are for employees that may not be in these areas initially, but the change in the environment related to COVID-19 may have them doing some functions that they did not do before. So really, our clients are going to need to look at this in detail to see if they can substantiate in meeting under these guidelines. There are some other examples that are included, and if you're interested, I can certainly share that information with you, but in the interest of time, I won't go through all of them. They do cite, I did want to mention one more. As far as ineligible expenses, they do cite that payroll or benefit expenses for employees whose work duties are not substantially dedicated to mitigating or responding to this public health emergency are not eligible. So that's where I'm saying there really needs to be a differentiation and a substantiation of where that those payroll expenditures fall. Now let's briefly talk about the Economic Stabilization Act that's included in the CARES Act. I have a brief overview here, and this basically they do define what a municipality is for this particular Economic Stabilization Act. The initial legislation really just authorized up to $454 billion in use for loans and loan guarantees and other investment programs established by the Federal Reserve Board. This was going to include purchasing obligations directly from issuers as well as in secondary markets and making loans. Paragraph E of the initial legislation allows for governments to participate in the program or facility to be set up to provide liquidity to the financial system that supports states and municipalities. Again, in the CARES Act originally, not a lot of guidance on what this was going to be. It was just saying that the Federal Reserve Board was authorized to set this up. Then, on April 9th, some additional guidance was announced to expand lending programs to provide up to $2.3 trillion in financing. This included Treasury equity investments into a municipal liquidity facility, and that would provide up to $500 billion in direct financing to states, counties, and cities to provide funds for essential services during the pandemic. It was intended that these funds could offset some delay and loss of tax revenues, since we didn't get any kind of relief related to the Coronavirus Relief Fund, as it would only relate to expenditures and could not be used to offset any kind of tax revenues. Current guidance that's out there now does not indicate that any kind of liquidity loan would be forgiven, like you've seen under the Paycheck Protection Program, where loan forgiveness would be allowed. So this is not currently allowing any kind of forgiveness with these loans. Next, I thought it was important to, even though this doesn't encompass everything that's included in Division B of the CARES Act, it does show an overview of some of the funding that's related to this. And from a staff and senior perspective internally, I think that I just wanted to make sure that everyone was aware of this funding and to know that it is going to impact your single audits this year. I know Greg will talk about, financial reporting and single audit type aspects later, but it is important to know that, this funding is going to impact single audits across the board. So I wanted to give you an idea of some of the items that you may see with some of your clients. Under HUD, the CARES Act provides for $5 billion of CDBG funds for services for senior citizens, the homeless, and public health services. Revisions have allowed more of an expedited process for this in response to the pandemic, and they have provided a little more flexibility on eligible uses. The eligible uses of the funding include constructing or rehabilitating facilities, special economic development assistance, planning and capacity building, as well as reimbursement for new or increased public service costs and technical assistance funding for local government. The CARES Act builds on the features of the conventional CDBG program, as well as precedents set by appropriations in response to disasters in the past. It appropriates $5 billion total for the Community Development Fund, and then it's going to be allocated in various ways. Of the total, $2 billion is to be supplemented under the conventional CDBG program. The Act directs HUD to administer those funds pursuant to the Housing and Community Development Act of 1974. That provision calls for HUD to allocate the supplemental funds to the CDBG grantees, and that's going to be in proportion to their conventional CDBG allocation for fiscal year 2020 that was published by HUD in April. The Act also directs HUD to allocate $1 billion of total appropriation to states outside of that standard formula. This funding is intended to prevent, prepare for, and respond to coronavirus directly. This is going to be based on public health needs, as well as the risk of transmission of the coronavirus, as well as the number of coronavirus cases compared to the national average for that specific locality. The Act also grants authority to the Secretary of HUD to identify additional factors. Those funds were to be allocated within 45 days of the bill's enactment, and I just saw earlier this week on May 12th that the HUD has now released the funding allocations for that second level of funding. The remaining $2 billion is to be distributed to states and units of local government on a rolling basis, and that's going to be at the discretion of the Secretary. Those formula factors will be defined by HUD. Under the Department of Justice, there's $850 million for the Coronavirus Emergency Supplemental Funding Grant to assist state and local law enforcement and jails to prepare and respond to coronavirus. If you were eligible, or if you're client was eligible for, as a recipient for the Burn Justice Assistance Grant in fiscal year 19, they are automatically eligible for this funding. There is a closing deadline to apply for the funding by May 29th, and I've provided the link here to see additional information on that, and the application is also included there. Allowable costs for this grant include overtime, equipment, hiring, supplies, training, as well as travel expenses and addressing medical needs of inmates specifically. Most of the CDC funding came through the first stimulus package, but the CARES Act does provide for $1.5 billion for state and local Preparedness and Response Act funding. These funds could be used for grants for rent, lease, purchase, acquisition, construction, renovation, or of non-federally owned facilities, as well as to improve preparedness and response capability at the state and local level. Under the Department of Agriculture, there's $24.6 billion for domestic food programs included in the CARES Act. There's also $15.8 billion to improve access to Supplemental Nutrition Program, or SNAP funds. The majority of the SNAP funds, or about $15.5 billion, has been placed in the contingency reserve that's to be allocated as deemed necessary. So most of those funds have not been allocated as of yet. There's also $8.8 billion of additional funding to be allocated to the Child Nutrition Program. This would help with the needs due to the pandemic, as well as the Commodity Assistance Program received $450 million, with $150 million of that used to with the distribution of commodities. Regarding the Federal Transit Administration, there have been $25 billion allocated in proportion to the fiscal year 20 program apportionment of urbanized and rural area formula funds. This funding also increases the 100% federal share, so there's no local match required on these funding. It's going to cover basically all operating expenses. The primary intention with this funding was to keep transit systems operational. So many of the operating expenses and administrative leave expenses due to reduced operations are eligible for reimbursement under this fund, as long as they've been incurred beginning on or after January 20th of 2020. Under FAA, there was $10 billion to support U.S. airports experiencing severe economic disruption caused by COVID-19. This would include $9.9 billion by way of the Airport Improvement Program, and divvied up between $7.4 billion for commercial service airports based on FAA formulas. The $2 billion is available to large, medium, and small hub airports, allocated based on AIP primary entitlement formulas, and then $500 million to raise federal funding share to 100% for projects funded with fiscal year 20 Airport Improvement Program funds. Only expenses incurred beginning on January 20th, again, will be eligible. And I just wanted to point out that FAA has also released some frequently asked questions on their website, as many of these agencies are, as questions are coming about with this various funding. So I would just encourage you, if you have some airport clients that have questions, you may want to direct them to these frequently asked questions on the website. It might be a good resource for them. Under FEMA, FEMA provides funding to eligible applicants for costs related to emergency protective measures. The protective measures activities conducted are to address immediate threats to life, public health, and safety. So eligible applicants can submit funding requests to FEMA through the Public Assistance Grants portal. There's Assistance to Firefighters grants that opened the week of April 27th, also available on their website. And that one will close on actually tomorrow, May 15th. Also, the Emergency Management Performance Program grant provided $100 million in funding to the state. The expected notice of funding was anticipated on May 8th, and while I haven't seen anything, those funds may have been distributed to the states at this point. There's also Emergency Food and Shelter Program grants totaling $200 million to provide jurisdictions across the country to supplement local service organizations, providing those critical resources to people during this economic emergency. And I did see a press release dated May 4th that indicated that some of that funding related to the food and shelter program specifically should be awarded to jurisdictions beginning as early as June 2020. Under the Department of Education, the CARES Act includes over $30 billion for an education stabilization fund. Under this fund, there's 4 grant programs that were created through the CARES Act. It would be the Education Stabilization Fund Discretionary Grant. There's also Governor's Emergency Education Relief Fund, Elementary and Secondary School Emergency Relief Fund, and then an Emergency Relief Fund for Higher Education. For the discretionary grants, there's 2 types of grant competitions. One relates to rethinking the K-12 education model, as well as there's another opportunity for re-imaging workforce preparation grants. Congress set aside $3 billion of that $30 billion for the Governor's Emergency Education Relief Fund. That department will award the grant based on a formula in the legislation. This includes 60% of the basis of the state's relative population of individuals aged 5 through 24, and then it's based on 40% of the state's relative number of children counted under the Elementary and Secondary Education Act. And then there's an additional $13.2 billion that's included from the Department of Education for the Elementary and Secondary School Emergency Relief Fund. The department will award those grants based on providing the local, they'll provide including emergency relief funds to address the impact of COVID-19, but it also will be based on the Title I Part A proportion that each state receives. The other $14 billion is related to this higher education emergency relief. Since that isn't the primary focus of most of our government clients, and we do have a webinar out there specific to this topic, I won't go through this slide in detail, but just know that it is part of the Department of Education's portion of the CARES Act. So I'm about to turn it over to Greg, but just before I do, I just wanted to emphasize here that, you know, there's a lot of clients that are going to be impacted by this. There's still a lot of unknown as to what's going to come about, additional guidance, additional stimulus packages. So it's just important that we stay on top of, you know, what's going on, try to assist our clients as much as possible and give them some guidance, because there's going to be a lot of questions regarding, you know, how to allocate expenses and such. It is important that we recommend that everyone is tracking those expenses so that they can be substantiated for any funding received. And with that, I'll turn it over to Greg.
Thanks, Tracy. Yeah, as Tracy mentioned, a lot of this is materializing as we're talking. So even some of this information that has been in these previous slides, they are adding new guidance every day. Virginia just sent out some communication 2 days ago on how they're going to roll out the CARES Act funding from a state level down to the localities, and what they're anticipating to see from those localities. So that information is coming out every day. So this is a fluid situation, and hope everyone stays tuned and keep posted of that. But as all the efforts that Tracy's kind of talked about, that the government's been doing to try to keep the economy going, I mean, Tracy talked about a lot of the federal perspective stuff, but there were other items that states and local governments are doing to support relief during the COVID-19 pandemic. Let me get you the right slide. So all of those items that Tracy talked about will have some kind of cash flow impact to governments, and will also have some reporting implications for this next fiscal year coming up. So before we get into any specific financial reporting, here's our next code word, and that's GASB. So I'll give you a moment to write that down, or just go ahead and put it into Engage You as we're going through to make sure you get your CPE. So over these next couple of slides, we're going to go over accounting and financial reporting issues that aren't typically dealt with in the public sector. But for the sake of time, I'm not going to just sit here and read off individual GASBs to you and how that might affect our particular clients in certain situations, but rather just give an overview of things to consider when we're preparing our risk assessments for this year and starting to look at financial statements from our clients. If you do find any of your clients that have any of these specific topics, it's applicable to them, GASB has put together an emergency toolkit or a toolbox, and that's a quick reference point you can go to find the authoritative guidance that deals with a particular topic, and that's available on their website. These are some of the topics to be thinking of from a statement of net position perspective, particularly on here pointing out fair value measurement, impairments, and debt issues. So fair value measurement impact is primarily going to be dependent upon how severe the pandemic is at the reporting date. So in Virginia, North Carolina at 6:30 or Florida at 9:30, depending on what the economy is looking like at that point in time, depends on what the impact will be on those valuation assessments. When we're looking at how our clients are doing their valuations, there's a potential that the activity in the markets might be at a lower volume or lower level of activity. And if that's the case, the way clients have been performing their valuations may need to be reviewed to make sure that they're still relevant, that the techniques that they've used in the past are still relevant today, given the level of activity in the market. From a disclosure standpoint on the fair value measurement, we need to be checked their disclosures to make sure that they're including sufficient information that the users of the financial statements can get a good picture of what's going on. So one of the items that might need to be added to the disclosures is whether or not that management has considered COVID-19 and evaluating fair market value, and any of the assumptions that they've changed since COVID-19 and how that impacts any inputs, and then any relative sensitivities to those assumptions. So in the commercial world, we probably see impairment analysis done probably more frequently than we do in the commercial world, but or in the government world. But in the government world, we still have the same requirements to evaluate impairment on long-lived assets at the end of a reporting period. So that's still relevant here in the government world. So we need to pay attention to that this year. If a client won't be able to recoup back the cost of their capital assets because they're not able to use it with shutdowns, they may need to be looking at whether there's some kind of impairment in there with any long-lived assets. Again, the more the current environment's unclear, the more important it is for our clients to provide detailed disclosures and the assumptions taken, as well as any evidence for those assumptions, and to disclose those within the notes to their financial statements. From a debt perspective, there's a lot of our clients that will be affected by COVID-19 breakout that will experience some cash flow challenges, and as a result of that, they may need to obtain additional financing. They may have to amend terms of debt agreements or get waivers for some of their debt covenants. With some of these stimulus packages, financial institutions and insurance companies are being asked to kind of help work with borrowers to help relieve cash flow obligations. So if there are any changes to underlying debt agreements or other contracts, we need to be looking to those contracts changes and see if they represent a substantial modification or if they're potentially a completely new contract and a contract extinguishment. Additionally, from a debt compliance standpoint, bond covenants, some clients may be reaching out to get waivers for their debt covenants. And if clients are not able to get those prior to the event of a default, we'll need to look at how that potential breach of covenants could affect the timing and how it affects the classification of debt in their financial statements. So if a client has a breach of their covenants and that occurs before year end, and the breach allows the lender to demand repayment within 12 months, that liability should be reported as current within their current year financial statements. However, if that breach was done after year end, then it would be a disclosure event and not be reflected in the face of the financial statements. However, in either case, if a client is defaulting on any of their bond covenants, we do need to be aware that that could have an ability on our client's ability to continue as a going concern. So now through the statement of activity or changes, a lot of our clients have implemented a handful of budgetary relief efforts, and those can be delaying payments for certain expenses or accelerating future revenues. And although that may help from a cash flow perspective, those budgetary relief efforts will not have the same impact on the accrual or modified accrual financial statements, as those expenses have already been incurred and accelerating those revenues might not have actually been earned yet. Additionally, some clients might also be considering selling receivables or future revenues to help shore up some cash flow or to make bond payments. So even if they're not selling those receivables or revenues, there's a little bit of a valuation risk there against the receivables, and any allowance of doubtful accounts would need to be probably scrutinized a little bit more this year than in historical years. So for example, historical client payment behaviors might not be the same today as they were, say, a year ago or 2 years ago. We have businesses today dealing with lost revenue, they've just disrupted supply chains, and there's still some volatility in the financial markets. So when we're assessing the collectability of accounts receivable, management may want to start considering more credit risk characteristics for their customers, particularly looking at where they are geographically. Some places in the country have been hit harder than others with COVID-19, and some industries have been hit harder than others. So if you have a utility fund that has certain industries that use a lot of water, and that industry has been hit hard, and that geographical area might be hit hard, there might need to be more of an allowance set up against those ARs this year. From a financial reporting perspective, we need to be considering the presumption that the organization is a going concern, as well as any events or transactions that may affect prior year financial statements. From a government perspective, most of our jobs were either wrapping up and being issued, or had been issued a while back, depending if it's a 630 or 930 when the pandemic kind of rolled out. So we didn't have too much from a subsequent event note standpoint in our government clients like our commercial clients might have had. But nonetheless, with the evolving nature of today's current environment, even at 630, there'll be things changing afterwards, and we'll need to take an understanding of what those events are and what impact it has on the financial statements. Some of our clients affected by this crisis may be concerned about the survival of their organization, and the key is going to be their cash flows to see if they have enough cash to survive the next 6 to 12 months. There's going to be a lot of significant judgments involved with that, and as things materialize, those judgments will need to be updated. If we do find yourself in that kind of situation, you need to kind of be looking at what the disclosures need to be, how that impacts on the pandemic has been on the client, what their significant judgments were made in preparing their financial statements. And irregardless if there's a going concern or not, we're more likely than not going to have a disclosure in the financial statement that discusses COVID-19. And that paragraph in their notes might also be referenced in an emphasis of matter paragraph in our reports. Another thing to consider from a COVID-19 perspective is is the reporting of those activities on the statement of changes, is that something that is either unusual in nature or infrequent in occurrence? So that has a special reporting aspect of it. So that's something to be thinking about going into our government planning seasons. Either way, the decisions reached will have an impact on the activities and the presentation of the statement of activities. So these slides were developed a couple weeks ago, and as Tracy and I have mentioned, it is a fluid situation. So GASB has now issued GASB statement number 95. So it was an exposure draft at the time of writing the slide deck. So 95 has been issued, and this guidance postpones the effective dates for pronouncements that were not already in effect, with the exception of GASB 94. 94, the pandemic was already factored into the statement's effective date, so 95 wasn't necessary to relook at their effective date. So specifically, the big ones our clients are looking at are GASB 84 for fiduciary activity and GASB 87 on leases. Fiduciary activity, that's 84, has been postponed for 1 year, and then 87 has been postponed for 18 months. So it's a year and a half. So with that, that's our next next code word, and that code word is compliant. So write that down and put it into Engage You. So these next couple of slides is an overview of the pandemic's impact on the single audit. We'll kind of go through there. Hope you got that word down. Yeah, so we're going to go through some of the impact on the single audit. So probably the most common question we've received so far is whether PPP will be considered federal financial assistance and therefore be reported on the C fund subject to single audit. As Tracy mentioned earlier, the PPP program was not very applicable in the government world, but for those of you that work on non-for-profits, there could be some non-for-profits that receive that. And earlier this week, the SBA did note that it will not be subject to single audit requirements. And although that kind of helps with clarity on PPP, there's still a bunch of other aspects that Tracy went through from the CARES Act and whether those would be subject to the single audit or not. The terms and conditions for those particular programs should help provide a lot of guidance on this, but as we're starting to find out as things are rolling out, a lot of the CARES Act related awards seem to be silent on whether it's applicable to single audit or not, and if it is, it may not mention what CFDA or what cluster that funding should be reported in. So as federal agencies and OMB works through what is or isn't subject to a single audit and how funding should be classified, we need to be making sure our governments are monitoring and tracking any of their COVID-19 related funding that they're getting. So just kind of track it by award and see how much funding they're getting and then how many expenditures they're applying to that. That's also going to be beneficial from an NPD perspective when you're trying to figure out what your major programs are going to be for this year. For deadlines, the confusion continues. So OMB has issued 2 memos, M20-11 and 20-17. The first provides agencies the ability to grant a single audit submission extension for 12 months, but that agency has to codify that extension. And to date, only NIH has codified that 12-month extension. After the 20-11 memo, there was another one released by OMB, 20-17. That allows for a 6-month extension, and it requires no further action to enact that 6-month extension, but it does have a requirement that recipients maintain documentation to support the reason for the delay. And the FAC has also updated their website to note that you need to be providing that justification in your reporting packet when you submit your single audit package to the FAC. There hasn't been guidance on what specifically they're looking for, what it has to say, just that there's going to be some kind of disclosure around the reason for the delayed filing. So the big question here is if agencies are allowed to enact a 12-month extension, and then there's just the 6-month extension, is how can awarding agencies extend those deadlines for their expected rewards when we perform our single audits on an entity-wide level? So we look at the total CFA, see what programs might be major programs for the year and test those. We're not testing one particular agency in a year, we're testing various agencies across the entity. So the answer to that question is primarily going to depend on the actions of OMB and the federal agencies, namely with the updating and the release of the 2020 compliance supplement. So that supplement is currently on hold. They are currently working on it and working through it. The compliance supplement was in the process of being updated and was in legal review prior to the onset of the COVID-19 pandemic. Since then, 4 agencies have requested additional time to add COVID-19 related information and to also revisit the programmatic section of Part 4 of the supplement. Although there is the potential to change the agencies to change some of their PIC 6 compliance requirements, and that will have an impact on our single audit testing, I wouldn't anticipate there to be huge changes for particular programs that have allowable costs or cost principles or eligibility. I don't see those ones going away. For Medicaid, we're not going to get away from doing allowable cost and eligibility, but they might change some of the special tests or maybe perhaps some of the reporting requirements. So we'll have to keep a lookout for that as that comes along. From a major program determination standpoint, with the increased funding with COVID-19, we're more likely going to have some more high-risk type A's and could have additional type B programs pop. So I know there's a training tomorrow on single audits as you're going through that and start looking at your major program determinations for your localities. Know that programs like Medicaid, Child Nutrition Services, SNAP, those are probably going to have more increased funding than they have in the past. And then COVID funding from the CARES Act will also likely be on the CFA and will have an impact on what your thresholds are for type A and type B. With that, if we have more testing this year, there could also be an impact on our MPDs in future years, so an echo effect. So in 3 years, we'll have to look back and see what the programs were tested for 2 years. So that could have an impact on our MPDs further on down the line, not just this year. So as we kind of wrap this up, there's a couple compliance requirements that I was going to kind of walk through to point out some questions. This is probably more questions than it is guidance, but allowable cost is probably one of those that is going to be one that gets questioned a lot. We've already started receiving a ton of questions on allowable costs in regards to the CARES Act. Tracy kind of went through the police and fire department or police and public health individuals on whether their salary is allowable under that program. So we'll be looking for more guidance as things start rolling out from the Fed to the state. And then at least in the Virginia's standpoint, the state will be allocating out portions to send to the localities. And then from a procurement standpoint, when we're going through to test procurement, something to consider with the pandemic declaration, if that's going to be sufficient to be sole source exemption. So a lot of localities were trying to get out to purchase PPE very quickly when things are rolling out. Be justifiable there is a question we kind of need to ask. And then also some things that originally weren't planned to be paid with federal funding, localities might have decided while things are rolling out that if there's federal funding available for it, they might apply for it. So those vendors might not have been procured under UGG requirements. So something to be watching out for as we plan our single audits for this summertime. So with that, we are exactly at 2 o'clock. The firm does have a COVID-19 guidance center. This is a reference to that site. And you can use that link to see anything that's coming out with additional guidance and additional resources as it comes available. With that, thank you guys for your time. I hope you guys got a lot of information out of this. And if you have any questions, please feel free to submit those, and Tracy and I will try to respond to those as quickly as possible.